Although we live in times of great uncertainty and financial catastrophes, Howard Marks says this presents a unique opportunity to investors, one we haven't seen in 4 decades. Howard Marks really needs no introduction. With more than 50 years of experience observing markets, there is little for him in the way of surprise. This extraordinary opportunity comes as a result of the current sea change. What does the veteran businessman and analyst mean? And how can we make the most of this in a bleak economic climate? Let's find out. Howard Marks, the co-founder and co-chairman of Oaktree Management, has been through 2 major sea changes that he navigated in his career. Now a third is underway right now. It is taking us from a low-return world to what he says is a full-return world, a bargain hunter's delight. If you look at the period from the end of the global financial crisis, roughly '09, through the appearance of the pandemic, and then in the 20 and 21, the Fed took extreme measures to save the economy. They worked at very low interest rates, the lowest in history, 0 for much of that time, and quantitative easing, the buying of bonds to put liquidity in the economy. These things produced what he calls an easy environment in the economy and the markets. He had the longest economic recovery in history. It was easy to make money. We had low-cost capital, so it was easy to make a profit. We had very few defaults and bankruptcy. It was easy to stay in business, easy to access capital. Everything was easy at that time. And in the last year, of course, with the appearance of the inflation and the increasing rates to try to stamp out the inflation, things have gotten harder. People today say, when are we going back to normal, like it was 5, 6, or 7 years ago? And the important thing to know is, that wasn't normal. That was the easiest, the best of times, and Howard Marks believes we're not going back there. We're now in an environment of more normal circumstances, and we're going to roughly stay this way. Howard Marks says, well, do we go back? I mean, what do we go back to at all? Because when I sort of read that memo, and I look at sea changes, it sounds like everything is new. It's never really a reversion to where we were in the past. That's what a sea change is. It's a complete transformation, not just a minor cyclical fluctuation. So I think that the business world, the economic world, is not supposed to be easy. It's not supposed to be easy to make money. It's not supposed to be easy for companies with bad business models to stay in business as it has been for the last 14 years. Howard thinks we can go back to a period in which we have moderate interest rates, moderate event availability and capital, a moderate default rate, and so forth, all of which will feel less accommodative than the last 14 years. But so much of the objects on the market right now is, of course, people trying to find out what the new rate is. If you want to call it a neutral rate or whatever. But when was the last time you could remember that we had a stable and persistent neutral rate? That depends on your definition of stable, time-wise. But Howard Marks thinks that the Fed became activist with the arrival of Alan Greenspan in the mid-90s. If there was a problem in the economy, the Fed would just squirt in some liquidity and solve it. They frequently did, including Y2K and other real and imaginary crises. The arrival of the bursting of the TMT bubble, for example. So that's 25 years we haven't had a free market in money. 0 interest rates are really an emergency measure. As the co-founder of Oaktree Management put it, someone gets a heart attack, you give them a shot of adrenaline. Works, right? That doesn't mean you start your day with a shot of adrenaline every day for 7 years. It couldn't be better said. We had rates at 0 for 7 years, and by the time 16, 17, and 18 rolled around, people started to say, well, shouldn't rates be a little higher? So that if we have a recession, the Fed can cut rates and become accommodative. But if rates are at 0 or a quarter or half, you can't do that. That's an important reason why rates should be positive. If you want to fight inflation and kill off inflationary psychology, you need a positive real Fed funds rate. The Fed funds rate has to exceed the rate of inflation before that's the case. But is there a historical precedent that the billionaire looks to that maybe gives a little guidance somewhat? Not really, because Howard Marks would rather quote Mark Twain. History does not repeat, but it rhymes. We haven't had much experience with inflation. Howard Marks lived through the last one, which was in the 70s, a most unpleasant decade. But then the situation was different. The sources of the inflation were different. It reached the mid-teens. Marks doesn't think we're going there this time, but that the original reasons for the current bout of inflation is too much money chasing too few goods. Not good news. Money from the pandemic, Relief money people put in the bank in 2020 because they couldn't spend it, and then a supply mechanism that was sputtering too much money, chasing too few goods that will correct over time. The extra money will get spent. Supply will catch up. Howard thinks the forces behind inflation will abate. So that puts us in a situation where the risk profile is going to be a lot different. The 77-year-old businessman started his career at a time when risk was a much different thing, at least relative to what he saw over the last 15 years or so here. What does that mean for the next generation of investors? What are they facing when it comes to how they have to assess that risk? Howard indicates that anybody who joined after '09 pretty much only saw good times, except for a couple of bad months in 2020 in connection with the lockdowns. But for his first 30 years in high-yield bonds, 78 to '08, the average default rate was about 4% a year. In the last 4 decades, it was only 2% a year. I think 4 is more normal, and defaults and bankruptcy should not be that scarce. I think we'll be going back to a somewhat harsher environment. But what do we make of the rally that we've been seeing lately in high yield? The co-founder of Oaktree Management thinks the current prices are roughly sustainable. That is to say, yields are not going to keep coming down. He adds that rates are roughly where they can stay, except that it's important to recognize that the debate today is being dominated by people who are optimistic, by people who think that the recession won't be too bad, won't be too long, that the inflation will give way, and that the Fed will be able to turn accommodative soon. Howard says the Fed is going to want to be somewhat strict and hold that position, well, say throughout the year. The Fed would not want to be seen as being too optimistic. So that makes sense, right? What's the current state of the market right now? Where do we stand? The billionaire thinks that in many years in the stock market, for example, a significant degree of optimism is ruling the day today. If you want to look at pessimism, look at June. Look at September. People were not so optimistic about this pivot, so we've been going back and forth, and the S&P, for example, has been trading in a channel between 3,700 and 4,000 depending on whether the optimists or pessimists were in the ascendancy. Right now, I think the optimists are in the ascendancy. Who knows how the events will bear them out? This has happened before. Prior to 77 and 78, there was a sea change that was the advent of high-yield bonds. A bond rated below investment grade could not be issued. Moody's defined a B-rated bond as follows: fails to possess the characteristics of a desirable investment. In other words, bad idea. After Milken and others arrived in 77 through 78, the new way of thinking was, well, it's not a great company, but the promised rate of interest is enough to compensate for the risk. And for the last 45 years, Howard points out that we don't think of good idea, bad idea. We think risk return, risk return. Is it how risky it is? The risk is the promised return adequate to compensate for the risk. And that's very important. I was lucky to be asked about the former Ohio Bond Fund by Citibank in '78. The people who started doing it earlier could find places that people were saying, oh no, we wouldn't touch that. That's low grade. Yeah, and where you could get a return without taking much risk. That was kind of a free lunch. Yeah, efficient markets tend to cause free lunches to go away, but it was great to get there early. Once again, timing is key. How do you plan to thrive in rough seasons like these? Let us know in the comments section below. Don't forget to like, share, and subscribe to our YouTube channel so you never miss out on any of our videos. See you next time. Stay tuned.